FPO, or simply put, follow on public issue, is just a way in which the corporates raise funds as well. There are multiple mediums available to them, whether with respect to IPO, OFS, preferential issue through qualified institutional placement, rights issue, etc. And FPO, or follow on public offer, is just one way of doing that for the company as well, which allows them to issue new shares to existing as well as new shareholders. And it's a win-win for both the company as well as investors. First, with respect to the company's perspective, it not only allows them to raise funds which might be used for general corporate purpose, capex, as well as reducing the debt. This also allows them to diversify their equity base as well. And as far as the investors is concerned, well, they stand to benefit because it allows fresh and new investors to participate with not a large threshold when it comes to the minimum investment requirement. And also FPOs usually come at a discount, which means that the retail shareholders are able to participate in the upside as far as the entire story goes. And more information is also available as part of FPO, because at the time of IPO you do not have the track record of the company, you don't have the performance so far, and you don't know what the corporate governance, etc. really is for the company. But with FPO you already have those data available, so it's easier with respect to decision making. Now the question comes, how does a company decide whether they have to go for rights issue, preferential, or even FPO? Let's compare it with rights issue first. The problem with rights issue is that the company can only go to the existing shareholders to raise funds. Of course, there's rights entitlement which they can sell in the market, but originally speaking, rights issue is meant for the existing shareholders. Plus, regulations are a bit different when it comes to rights issue. Talking about preferential issue, where the problem there is that it does not allow diverse shareholders to participate, because preferential issue usually happens to a particular party or a set of parties, and that means they have a higher participation when it comes to decision making. It might come with, let's say, a let go of board seat, etc. as well, and they might come in as strategic investors and not just financial investors. So decision making for the promoters might get diluted, and of course the dilution happens for the retail shareholders as well, because their overall stake in the company falls down. So preferential issue is not the most beneficial when it comes to rights, when it comes to raising funds for the company, and the better way of doing it is either rights issue as well as preferential issue, and those are the basics as far as FPO is concerned, guys.
If you like this video, then like, share and subscribe to ET Now.